grass is growing and the paint is drying in good order. The market's doing very little today when we look at the big benchmark US indices, but there is a bit to look forward to that might reignite volatility here. This is Macro Money. I'm Millions Pivak, head of global macro here at tastylive. And we're going to look a little bit ahead here. We would typically do a preview of key economic data a day out, but we're going to go a little bit early here this week and dedicate tomorrow's show to looking even further afield. So we're going to check out the main piece of economic event risk on this calendar, which comes to us on Friday, a day early, and focus on the U.S. PCE inflation report that is going to round out this relatively boring week of economic data on the calendar and see if we can't figure out whether this actually matters, because we have had a narrative here, of course, really since the beginning of the year that's been incredibly Fed-centric. And the latest episode in this story has been nothing if not the same. So what we'll do here is we'll do a bit of stage setting. We'll figure out exactly what it is that we're looking at here vis-a-vis this data, how the policy outlook has evolved going into it, how it might evolve with the publication of these numbers, and whether we can surmise anything about what stock markets might do in their wake. So let's take a look here first at what it is that we're expecting to see. So the PCE report is the Fed's favorite inflation gauge. Of course, the CPI comes out earlier and is more of a globally consistent like-for-like benchmark, so generates a lot of market attention. But this is the gauge that is favored by Fed officials. And we can see the story here as a familiar one. We've seen significant disinflation on the goods side after the peaks in the wake of COVID. That, of course, occurs right here. We've seen significant disinflation likewise in food and in energy. Here were the peaks in both. They've since come in, and energy is now only just starting to have a positive contribution again to inflation, if only a very, very modest one. Food has been squeezed down to next to nothing. The two main categories of inflation that remain and continue to bedevil the Fed are housing and services. And clearly, we can see here that with inflation hovering in the sort of mid-twos, addressing services would go a whole lot of a long way to getting the Fed toward its 2% inflation target. And of course, to the extent that this unlocks rate cuts, it would also unlock inflation in the housing market, where the main issue really has been Fed rate hikes in and of themselves. They've pushed out buyers, they've pushed out sellers. And so getting that market to unlock and getting the pricing in that market to adjust lower probably needs the start of the easing cycle, but getting into the start of that easing cycle probably requires dealing with services where the situation mainly remains sticky labor costs. So that's the state of affairs here as ever. And the expectation is that after 3 months of standstill on the core PCE measure, which approximates that service sector reading because it, of course, excludes energy, excludes food, and as we can see here, really echoes what this is doing here. That is expected to resume disinflation after being stuck at 2.8 for 3 consecutive months. So we're looking at 2.6% on that core reading. That would be a near 3-year low, the lowest since March of 2021. On the headline, same number, 2.6, but of course, since we've had a little bit of wiggling up here recently around the energy part of the story coming back from being a negative contribution to a slightly positive one, as we've had the fall in energy rebase essentially in year-on-year calculations, that would be a 3-month low. Not too shabby, but not as dramatic, certainly, as what is expected to occur at the core. Now, of course, the key question, bar none, is why do we care about this? And the answer is very simple. We have been watching a very clear, very transparent story in these markets for the past 10 weeks. Since mid-April, what do we see? The Fed has loudly talked up its frustration around disinflation stalling. We just talked about their favored measure, the core PCE, being stuck at 2.8% for 3 consecutive months, April, March, February. We heard their frustration in public comments. We heard it in recent policy rhetoric around the meetings in May and in June. And so the story has been consistently, we don't feel like we have the evidence to cut at this point. At the same time, they are clearly very reluctant to hike. We see that show up in their summary of economic projections. We see, again, all of that show up in the rhetoric. And so the markets have, reasonably enough, walked away with the idea that what all of this means is that the Fed is not going to cut as much this year, but might have to cut more next year because they will have waited longer and will need to play catch up as inflation comes in. We see that here in relatively short order because we can see in the gray here the outlook for a Fed policy as it is baked into Fed funds futures this year. In the yellow is next year. The orange is the sum of the two. Notice, for the past 10 weeks, since mid-April, the outlook for this year is a flat line. We're kind of tinkering around 125 basis point cut plus or minus a few basis points, depending on when you look. Sometimes it's a little bit more hawkish. Sometimes it's a little bit more dovish. We've not really moved off that one cut consensus in over 2 months. The story for next year, given that the Fed is signaling this higher for longer narrative, is very much in motion. We can see here that this yellow area, having been this narrow here, has become this wide here. So clearly, while the outlook for this year has stood still, echoing the Fed's hands being tied in their own reckoning, and then next year, the catch-up rate cuts filtering into the forecast. So we've gone from about 80 basis points in cumulative rate cuts here to about 125 now. So we're looking at a full 5 cuts being baked in between now and the end of next year. What we also see very, very clearly is how much the stock market needs for this narrative to continue in order to keep momentum. Look at where the stocks bottom, right when this begins to widen out. Look at the extent to which these moves are inverse of each other. It's pretty clear. When you get a period of loosening, stocks rise. When you get a period where the outlook looks less dovish, stocks struggle. When there's renewed loosening, stocks rise. Now that we've kind of anchored here around the 5-cut outlook over the past, let's call it, week and a half or so, stocks have stalled. This is why we care. Because if we have a situation where, seemingly, The stock market needs for there to be some version of a live dovish conversation, some sort of a live dovish adjustment occurring in the markets in order to go higher. And we don't get that kind of catalyst in this set of PCE numbers, when the stock market has some trouble on its hands. Here's what ostensibly needs to occur if you're the Fed. You need to see that the trending here has started to go your way. At the 3-month annualized rate, at the top here in the blue bars for the PCE index, that has ostensibly started to roll over. So if we take the 3-month change in the PCE index and we look at that annualized to get a kind of high frequency annual inflation rate, which the Fed looks at, then we can see it's rolled over. So basically since December of last year, it's been going up. And as of April, it's come down. What the Fed wants to see is more in this direction. Notice the 6-month annualized hasn't done that yet. The break has not as yet occurred. Even in April, there's still this upward move here. So if the story were about confidence in cutting, what needs to happen here is the Fed needs to get the kind of data that would make it more confident. And were that to happen, were the data to signal that this is something the Fed is going to take and say, good, we can move up the rate cut tally, or at least we can consider issuing the cuts sooner, then perhaps if this overall calculus shifts down again, stocks have another leg higher in them. Now, how much of this is already in the outlook? Well, here's the Cleveland Fed's expectation for where the PCE index is going. And we can see here in the green is the forecast for the year-on-year core. In the yellow bars is the headline. And we can see that both the outlook for May, which is the data that we're going to get this week, and for June as well, give us declines at the headline. A little bit lower here, a little bit lower there. We are mainly in line with expectations of 2.6 for this month, and it looks like we have scope to edge a little bit further downward in June. Although, as we can see here, the core index isn't really seen making significant progress. It still looks a bit stuck. And that, of course, is where the Fed needs to get its confidence. As we've just talked about, that's where it is more focused than the headline. Now, the CPI set of numbers that we just saw gave us softer inflation than expected. So this is a relatively good sign. And the place from whence the disinflation came, as it were, was the correct one. So if we look at the components here, the decline in headline was mainly powered at the core, and the move there saw disinflation in both goods and services, but of course, importantly, services. So it looks like we may have the ingredients for resumed disinflation, but of course, that's already been the story in April. CPI already started to march lower. PCE did not, and the Fed was left only a little bit more optimistic. So this is helpful, but not necessarily game changing. We also see that the U.S. Economic Surprise Index is pointing to increasingly soft outcomes relative to expectations. Now, this speaks to some level of cooling in economic activity, at least in relative terms. So whatever economic data that economists had on their bingo card is seeing surprises on the downside. And what that is telling us then is some sort of a adverse story, at least relative to forecasts, seems to be occurring in the economy. This is probably a disinflationary narrative and consistent with expectations that we're going to see prices resume their march lower. Now, taken together with the CPI, this does seem to endorse the idea that PCE is going to tick lower, even though, of course, we have some conflicting indicators, especially in the PMI data. We just got the flash data for the S&P Global edition of the PMIs, and we can see the U.S. economy, especially the service sector here, looks quite robust. So we do see that overall data is underperforming, but clearly there's an interesting element here where now both the ISM and the S&P Global numbers are telling us that what we're getting is activity growth without parallel inflation. Employment and the price indices in both surveys have been a little bit soggy, even as overall economic activity has picked up. So there's a little bit of a back and forth here in the data, but it does seem to broadly agree that disinflation appears to be resuming to some extent in line with what the baseline forecasts are. And of course, generally, once the PPI and CPI numbers are out, the markets are fairly good at forecasting the PCE result. So it does tend, more often than not, to land very close to forecasts. Now, to some extent, that would suggest that we're going to get a favorable outcome here from the perspective of risk sentiment, because the resumption of disinflation, even with this kind of spicier look on the service sector and overall activity surveys, would still give us perhaps some confidence in a rate cut narrative. It is worthwhile to mention that if we take the San Francisco Fed's breakdown of PCE into cyclical and acyclical factors, it is a little bit concerning that the acyclical part has stalled and the cyclical seems to be, if you squint hard enough, flattening out a little bit. And so if it's the acyclical part of inflation that has appeared to be stuck here, and the cyclical one that's been coming down, if in fact the PMIs are right and the economy is accelerating here a bit, then this is going to be an issue. And the overall index here might bedevil the Fed yet. But we don't, at this point, have sort of clear confirmation that that's the side of it that's winning out. Indeed, as we just saw, the data seems to be overall cooling. So the main question then is, we get a PCE number at the end of the week. It tends to land in line with expectations or close to them, and those expectations see disinflation resuming. Around that idea, we've not seen the markets adjust to fewer rate cuts. We've seen them move those rate cuts from this year into next year, and in fact, to put more of them into next year, as if to say the overall tally of cuts from here to here is expanding, which means disinflation ostensibly is going to accelerate because the Fed is going to need to do a degree of catch-up. So how much of this is already priced in? If the number that we get is relatively close to expectations, do we have any sort of sense that the Fed might do any more easing than we already have here? Maybe not. And as we can see, the absence of a degree of expansion in the dovish outlook here has left stocks rudderless. If the number is not going to get this narrative moving further, might we get some distribution here? Might the stock market at least have some tactical divestment where people go, okay, well, we had a nice 10-week narrative. That narrative seems to have hit a wall. Let's step aside here a bit. Let's let ourselves find a new tailwind because the speculative juice in the current one has run dry. Maybe so. We shall see. For now, looking at the structure of the current ES contract here, does look like the very immediate move higher, defined as a series of higher highs and higher lows, has been violated on the downside. But so far, this looks no more than a sort of sideways digestive period. Now, if the PCE or something ahead of it gives us a push through this low, well, then maybe we have scope for a descent somewhere here into the 54 area. But as ever, we need the price action to confirm. At the moment, the key question for this data is, will the markets find anything here to remain optimistic? Not so much in the economy as a whole or the AI narrative as a whole or even the scope for Fed easing as a whole. But will they find a reason to get this tally moving lower? And if they can't, and speculative fervor from the story has been squeezed out, then why not see a period of correction at record highs? And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and what that might mean going forward. I'm on with Victor Jones for the Price of Truth just 30 minutes after we wrap up here today, as I am every Wednesday. Back on with Chris for Futures Power Hour on Friday. Back with Victor and Tom for First Call Sundays, writing for the News and Insights portion of tastylive.com and opining sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. Macro Money's back tomorrow. Price of Truth is with you in just 30 minutes time.